Welcome back to JRNY TV. Today we are talking about stablecoins and why they matter. If you've delved into the crypto world, it is likely that you've encountered the term stablecoin. But what exactly are stablecoins, and why have they become such an integral part of the digital asset ecosystem? In essence, stablecoins are cryptocurrencies that have been engineered to maintain a stable value, typically pegged to traditional fiat currencies like the US dollar. Unlike notorious volatility associated with assets such as Bitcoin or Ethereum, stablecoins strive to uphold a consistent value, often around $1. This stability renders them invaluable for traders, investors, and businesses that are seeking the advantages of digital currencies without the unpredictability of price fluctuations. The significance of stablecoins? Well, it lies in their role as a bridge between traditional finance and the burgeoning crypto landscape. While decentralized finance offers innovative financial solutions, the inherent volatility of many cryptocurrencies can deter mainstream adoption. Stablecoins mitigate this concern by providing a reliable medium of exchange and store of value. For instance, in decentralized finance platforms, stablecoins are frequently utilized for lending, borrowing, and yield farming, offering users a dependable asset amidst the market's inherent volatility. Moreover, the impact of stablecoins extends beyond the cryptosphere, capturing the attention of governments and financial institutions worldwide. With a collective market capitalization exceeding $200 billion, stablecoins, well, they are increasingly employed in various applications, from facilitating cross-border remittances to serving as a digital alternative to traditional banking in regions with unstable financial systems. This widespread adoption has prompted discussions among policymakers and regulators who are keen to understand and oversee the integration of stablecoins into the global financial infrastructure. So how do stablecoins actually work? Stablecoins might all serve the same purpose by providing price stability in crypto, but they don't all work the same way. Different stablecoins utilize different mechanisms to maintain their value, and understanding these differences is crucial for knowing which ones are reliable versus which ones might be a ticking time bomb. There are three main types of stablecoin: fiat-backed, crypto-backed, and algorithmic. Each has its own strengths, own risks, and level of adoption in the market. The most common type is the fiat-backed stablecoins, such as Tether and USDC. These are issued by centralized companies that claim to hold real-world reserves of cash or cash-equivalent assets like US Treasury bonds to back every token that they issue. In theory, if you hold one USDC, you should be able to redeem it for $1 from the issuer. These stablecoins dominate the market because they offer deep liquidity, regulatory compliance, and strong institutional support. However, the trade-off is that they rely on centralized entities, making them susceptible to government regulations, blacklisting, or even reserve transparency concerns. Next, we have crypto-backed stablecoins like DAI, which are issued by decentralized protocols rather than companies. Instead of being backed by fiat, these stablecoins utilize cryptocurrency as collateral, meaning users deposit assets like Ethereum into smart contracts to mint stablecoins. While these stablecoins are decentralized and, of course, censorship resistant, they can be more volatile. If the value of the collateral drops too much, users need to add more collateral or risk liquidation. Lastly, we have algorithmic stablecoins, which utilize complex mechanism of supply and demand to maintain their peg. These have a history, unfortunately, of failures. Terra's UST collapse wiped out billions, but models like Frax continue to support the experiment with hybrid approaches. The takeaway? Not all stablecoins are created equal. One more time, not all stablecoins are created equal, and understanding how they work is crucial before trusting them as a store of value. The most popular stablecoins and their key differences. Well, not all stablecoins are created equal, and some, in fact, have created significantly, even built significant more trust and adoption than others. In 2025, the stablecoin market is dominated by a few major key players, each with its own unique strengths, trade-offs, and risks. Tether, USDC, DAI, and Frax are among the most widely utilized, but their structures and levels of decentralization vary significantly. Tether is by far the largest stablecoin with a market cap that exceeds $90 billion, according to CoinMarketCap. It dominates trading pairs on most exchanges and has deep liquidity, making it the go-to choice for traders. However, Tether has long faced scrutiny over its reserve transparency. While the company claims USDT is fully backed by cash and equivalents, its history of inconsistent audits has of course led to concerns about whether it could withstand mass redemptions. On the other hand, USDC, issued by Circle, is considered more transparent and much more regulated, with regular third-party audits and strong backing from US institutions. USDC has been widely adopted by traditional finance players and is often preferred by use in DeFi applications due to its perceived regulatory compliance. Then there's DAI, the leading decentralized stablecoin, governed by the MarketDAO protocol. Unlike USDT and USDC, which are issued by centralized entities, DAI is backed by over-collateralized crypto assets. While this makes it censorship resistant, it also introduces complexity and volatility. And as users, we must deposit more collateral than we borrow to ensure the system is stable. Frax, on the other hand, has taken a hybrid approach, partially backing its stablecoin with reserve while utilizing an algorithmic component to maintain its peg. Frax has been one of the more successful algorithmic stablecoins, avoiding the collapses that doomed previous projects like Terra's UST. As the stablecoin sector continues to evolve, these differences will become even more important, especially as regulations continue to tighten and institutional adoption inevitably increases. So why are governments and banks so concerned about stablecoins? Well, for starters, stablecoins have grown from a niche crypto tool to a massive financial force, and governments, banks, and regulators alike everywhere are starting to take them very seriously. With a total market cap of over $200 billion and stablecoins facilitating trillions of dollars in on-chain transactions, they are now being seen as a very real competitor to traditional financial systems. Unlike banks, which control deposits and lending, stablecoins allow people to move and store value outside of the traditional banking system, often with lower fees, faster settlement times, and even fewer restrictions. This, of course, has led to increasing concerns from regulators and policymakers who see stablecoins as a potential risk to monetary control and financial stability. One of the biggest fears is that stablecoin could undermine national currencies and banking systems. If enough people and businesses start holding and transacting in stablecoins instead of traditional fiat, central banks, they could begin to lose control over monetary policy and interest rates. This is especially concerning for countries with weaker currencies. Many people in inflation-stricken economies are already choosing USDT and USDC over their local money, effectively dollarizing their economies through crypto. Banks also see stablecoins as a direct competitor, since stablecoin issuers like Tether and Circle, just to name a few, can operate outside of traditional banking regulations while still offering a digital alternative to your cash. In response, governments everywhere are pushing for strict stablecoin regulations and even developing their own digital currencies, known as CBDCs. Some regulators want stablecoins to be fully backed by government-issued assets, while others argue that stablecoin issuers should be regulated by the banks. Meanwhile, central banks are racing to release central bank digital currencies, which would serve as state-controlled stablecoins that could replace private alternatives. While stablecoins offer financial freedom and efficiency, they also represent a shift in power away from governments and banks, which is why this battle is only just the beginning. With governments becoming increasingly wary of stablecoins, many are now developing their own central bank digital currencies, known as CBDCs. These are essentially government-backed stablecoins designed to function as a digital version of fiat money. Unlike decentralized stablecoins such as DAI or USDT, CBDCs would be issued and controlled directly by central banks, meaning every transaction could be tracked, regulated, and if necessary, reversed. Countries like China, the US, and the European Union are already exploring or piloting CBDCs, with China's digital yuan being one of the most advanced examples. On the surface, CBDCs might seem similar to stablecoins, but the key difference is who controls them. With stablecoin, users still have a degree of privacy, financial autonomy, and flexibility in choosing their preferred platform or blockchain. With CBDCs, every transaction could be monitored by the issuing government, raising concerns about financial surveillance and potential restrictions. For example, a government could utilize CBDCs to freeze assets, impose spending limits, or even program money to expire. What? Something like that is impossible with decentralized stablecoins. While CBDCs could bring faster payments and more financial inclusion, they also pose a threat to privacy and financial freedom. For now, stablecoins remain the dominant form of digital money in crypto, but CBDCs could become a serious competitor if widely adopted. Some governments may even push for regulations that favor CBDCs over private stablecoins, forcing users onto state-controlled digital currencies. This is why the debate around stablecoins versus CBDCs is so critically important. It's not just about digital money, but in fact about who gets to control the future of finance. Are stablecoins actually safe? What are the risks and challenges? While stablecoins are designed to maintain a fixed value, they aren't risk-free. Over the years, we have seen multiple instances where stablecoins have in fact lost their peg, suffered from transparency issues, or even collapsed entirely. The most infamous case was Terra's UST, an algorithmic stablecoin that crashed in 2022, wiping out over, wait for it, $40 billion in value in a matter of days. Even decentralized stablecoins like USDT and USDC have experienced brief depegging events during times of market panic, making it clear that no stablecoin is 100% invulnerable. One of the biggest concerns with stablecoins is reserve transparency. Fiat-backed stablecoins like USDT and USDC claim to be fully backed by real-world assets, but the question is, what exactly are those assets? USDC undergoes regular audits and is backed mostly by cash and US Treasury bonds, making it relatively safer. Tether, on the other hand, they have faced some criticism, quite a bit, for lacking transparency, utilizing commercial paper, and only providing periodic attestations rather than audits. If a stablecoin's reserves aren't solid, a wave of redemptions could inevitably cause it to collapse, similar to a bank run in traditional finance. Another risk is regulatory uncertainty. Governments are actively working on stablecoin regulations, and some could impose strict regulations or requirements or outright bans on certain stablecoins. If a regulator forces USDC or USDT issuers to freeze specific wallets or stop issuing new tokens, it could have massive ripple effects across the entire crypto space. Additionally, stablecoins depend on the stability of the financial system that they are tied to. If a major financial crisis were to hit, it could impact the backing of even the most reputable stablecoins. While stablecoins offer stability compared to volatile cryptos, it is crucial for users to understand the risks and choose wisely. How do stablecoins impact the crypto market? Well, stablecoins might not be as flashy as Bitcoin or Ethereum, but rest assured they are the backbone of the crypto economy. They provide liquidity for trading, stability for DeFi applications, and they are a safe haven during market volatility. When traders want to exit risky positions without fully cashing out to their bank, they in fact move into stablecoins, thus keeping their capital inside the crypto ecosystem while avoiding price swings. This is why stablecoins often dominate trading volume on major exchanges, sometimes even surpassing Bitcoin in daily transaction value. Beyond trading, stablecoins power nearly every major sector in crypto. In DeFi, they are utilized for borrowing, lending, and yield farming, making them one of the most utilized assets in protocols like Aave, MakerDAO, and Curve. In NFT markets, stablecoins provide a consistent pricing mechanism that prevents assets from being affected by volatile crypto prices. Even in remittances and cross-border payments, stablecoins are faster and cheaper than traditional banking systems, with many users in countries with unstable currencies opting to store their wealth in USDC or USDT instead of their local money. The biggest risk to the crypto market is what happens if a major stablecoin fails or gets heavily regulated. If something like USDT or USDC were to collapse or face legal restrictions, it would cause massive implications or liquidations and instability across exchanges, DeFi, and definitely beyond. This is exactly why the stablecoin sector is constantly evolving, with new projects emerging to offer safer, more transparent alternatives. As stablecoins become embedded even more in traditional finance, they could also attract institutional investors and regulatory frameworks that further legitimize crypto as a whole. Stablecoins are not just used for crypto traders. They are in fact already being utilized in real-world applications that go far beyond digital asset exchanges. One of the most important use cases is cross-border payments and remittances. Traditional remittance services like Western Union charge high fees and, as we all know, unfortunately can take days to process your transactions. With stablecoins like USDT, USDC, and DAI, just to name a few, people like you and I, we can send money across borders instantly and at a fraction of the cost, making them an incredibly attractive option in regions with unstable banking systems or high inflation. Companies that we have all heard of, like Visa and PayPal, well, they've already begun integrating stablecoin transactions, signaling that mainstream adoption is very well underway. Some e-commerce platforms, freelancers, and even real estate transactions now allow payments in stablecoins, offering users a fast and globally accessible way to exchange value. Another key real-world use case is protecting wealth in economies with failing currencies. Countries facing hyperinflation or strict capital controls, like Argentina, Venezuela, and Turkey, are seeing a surge in stablecoin adoption. When local currencies lose value rapidly, people often convert their savings into USDT or USDC to preserve purchasing power. In some cases, stablecoins are more accessible than traditional dollars, especially in places where governments limit access to foreign currency. As financial instability continues in different parts of the world, stablecoins may play an even larger role in providing financial freedom to millions of people. What is next for stablecoins? Well, the future trends and developments of stablecoins depends on the landscape. And the stablecoin landscape, well, it's evolving quite fast. And the next few years will likely bring major changes in how they're issued, regulated, and utilized. One of the biggest shifts is increasing regulatory oversight as governments push for clearer rules on reserve requirements and audits and consumer protections. The US, EU, and other major economies are actively working on stablecoin regulations, with some proposals requiring issuers like Tether and Circle to operate more like traditional banks. While stricter regulations could bring greater transparency and trust, they could also lead to more restrictions on who can issue or utilize stablecoins. Another key trend is the growth of tokenized real-world assets, known as RWAs, where stablecoins will likely play a major role. As more assets like stocks, bonds, and commodities get tokenized on blockchain networks, stablecoins will serve as the primary settlement layer, enabling fast and efficient transactions. This shift could integrate stablecoins more deeply into institutional finance, as traditional players look for ways to move assets on-chain while still transacting in stable value. Some projects are even exploring yield-generating stablecoins, where users earn interest just by holding them, potentially disrupting the traditional banking model. The biggest wildcard in the future of stablecoins? Well, that would be the rise of CBDCs, central bank digital currencies. While private stablecoins dominate today, governments may try to push users towards CBDCs as an alternative, especially if they regulate or restrict stablecoins to favor their own digital currencies. The ultimate question? It is whether stablecoins and CBDCs will coexist, or if governments will attempt to phase out private stablecoins altogether. Either way, stablecoins are here to stay, and their role in global finance and crypto adoption will only continue to grow. Stablecoins have become one of the most crucial pieces of the crypto puzzle, providing stability in a market known for extreme volatility. Whether you're trading, using DeFi, or simply looking for a faster way to send money, stablecoins have changed the way value moves across the world. But with increasing regulation, the rise of CBDCs, and the ever-evolving financial landscapes, Stablecoins are at a major crossroad. Will they continue to thrive as a decentralized alternative to traditional money, or will governments step in and take control? One thing is certain, stablecoins aren't going anywhere. They've already proven their utility in global finance, and as tokenization grows, they will likely become even more embedded in both crypto and traditional markets. But the real question is, how will they evolve? Will they remain open, permissionless, and decentralized? Or will regulators and institutions reshape them into something unrecognizable? Either way, stablecoins are set to play a massive role in the future of money, and keeping an eye on these developments will be crucial for anyone in the space. If you found this video helpful, please be sure to like, subscribe, and turn on that notification bell so you never miss an update on our deep dives or the crypto world. And let us know in the comments, where do you see stablecoins heading? Are they the future, or are they just a stepping stone? Thanks for watching JRNY TV. We'll see you in the next one.